Our next guest says that the outlook for the markets and the economy is positive overall, but there are 5 key risks to watch. Joining us right now is Bob Diamond. He is the CEO of Atlas Merchant Capital. Bob, it's great to see you, though I'm concerned that you're concerned about potentially maybe some of the risks in the market given where we are right now. What are you worried about?
Listen, Andrew, it's a very good environment right now. The stimulus packages that we've seen over the last year are certainly having an impact. I think we worry about with all the positives of the vaccine rollout, could we see something stronger in the COVID variants? Could we see fatigue in terms of how people are behaving around it? I think there are worries out there potentially around inflation and yields. I guess the biggest concern for me is really a longer term, which is the potential for asset bubbles. But with all that said, it sounds like I'm very negative. It's a great environment right now. We just have to be conscious that there are risks and that down the road, some of the stimulus is going to have to taper off.
How do you think about owning the big banks right now versus perhaps some of the fintech companies that have really been on a tear? I mean, frankly, both have been on a tear, but there's a bit of a rotation back and forth now.
There is. Listen, let me take the big banks first. The earnings have been very strong. I don't think any of us are surprised. Big write back of provisions, very strong trading numbers, particularly around equities. And within equities, particularly around some of the retail activity that's been going on. So in the environment that we're in, Andrew, this is unsurprising and actually very positive. The banks are quite healthy and continue to build their capital base. One of the questions you have to ask yourself is why are the PE ratios of the big banks, even at these levels, even with these earnings right now, trailing most other sectors of the economy? And I think one of the reasons is the longer term outlook is that the banks are still going to be challenged by their business models. They're becoming more national. They're becoming more concentrated. They're becoming more correlated with the local economies. I think at the same time, we're seeing a real invasion of some of the most profitable areas of the traditional banks, just as you said, by fintech or by specialists. Whether it's market access or TrueMid and the trading platform businesses, or so many of the fintech companies that we've seen go public recently. When you looked at the market cap of conventional banks 10 years ago, it was 95 to 96% of the total market cap of the sector. Today, it's kind of high 60s, low 70s as we're seeing more and more of the business go to the fintechs.
But so, Bob, the question I'd ask you as someone who's investing in this space all the time is, would you prefer to own a JP Morgan or would you prefer to own a PayPal or even a Coinbase that just came public?
We definitely think that there are better opportunities in specialists, monolines, particularly those with a technology angle. So without picking a specific one, because we're looking at a number right now, we're very, very focused away from kind of the big conventional banks, which we see as much more of a stable environment. But we see continued growth in the more innovative technology-based specialists for sure.
Separately, I wanted to get your thoughts, if I could, given that you've lived through a crisis or two, about how to think about what happened with Archegos Capital and some of the folks either minding the store or not minding the store that allowed that to happen.
Listen, I think it's a big thing. It harks back a little bit to too big to fail, Andrew. We had a very, very specific case with Archegos of lending against extremely large, extremely concentrated, highly speculative, highly volatile positions. This was not Main Street lending. This was not lending into the economy. These were a number of large financial institutions with guaranteed deposits in this business. And I think the question starts with, is this a business that the larger conventional guaranteed deposit institutions should be in or not? And then you get to the second question of why did it appear that the regulators were not aware of how much concentration and how much risk,
Right.
both around the single name stocks, but also around the positions at these firms.
Bob,
I think they're fair questions.
Shepard Smith here. Thanks for watching CNBC on YouTube.